Give us your take on what the markets told us this week, if anything.
So, what I find really quite interesting is what the markets didn't tell us, in the sense that now it's been a couple of weeks, we're actually seeing, I know that, we talk about big sell-offs, big rallies. We're talking about 3 basis points, 4 basis points, relative to what we've become accustomed to in fixed income markets. The last week and a half, actually, has been pretty stable, despite the fact that we've had data going one direction, data going the other direction. What I think is quite interesting is how little fixed income markets have actually moved. We're largely going sideways here.
So we heard from Larry Summers just now saying he's not sure he can see a trend yet. The numbers do seem to be a bit softer. We saw it in retail sales, housing starts this week. But do you agree with that? Is there a trend you can discern so far?
No, I would agree with him. Here's the thing. There are 2 things. One is that it is too soon to say that we're seeing a trend. The second thing is, even if we are coming off an incredibly strong economy. We need to cool down a little bit. I would say that the type of cooling we've seen so far is probably generally welcome for the Fed. We have been growing beyond potential now for a while, and we've had more inflation than we need. We've been growing above potential, and unemployment is coming off 40-year lows. We can't expect to stay there. So, this is some slowing, but I repeat, I'd say it's probably somewhat welcome to those people making decisions at the Fed.
So, Sonal, as you know so well, here at Bloomberg, we pay most attention to the Fed. What's the Fed going to think about the economy? What's it going to think about the numbers? Is there any message you think going forward to the Fed right now as we keep waiting about, are they going to cut? Are they not going to cut? When are they going to cut?
Honestly, at this stage, the market has accepted that the Fed is not going to give it the outrageous number of cuts that the market was demanding at the start of the year. We're looking at still less than 2 cuts. It's around 1 3/4 so far. Maybe the Fed cuts twice, maybe it cuts once. The bottom line is, I think what's more interesting in many ways is the total number of cuts, where I think here I'm still not in agreement with what the Fed is forecasting, which would take Fed funds all the way sub 4, not next year, but the year after. Overall, whether we go for 1 cut or 2 cuts this year is almost besides the point. The Fed wants to cut, and I think they will probably have space to cut by the end of the year. I just don't think it's going to be a dramatic series of cuts, absent some exogenous shock of some kind, I'd say. And it's not my baseline right now, but of course, things happen. And I think that's really important, right? To think about where the market is today and where it's come from.
So what about data coming from outside the United States? We tend to focus on economic data here, what's going on with the Fed, but we also have, for example, elections coming up in France and the UK. There are a lot of things going on around the world.
And I think that's actually something, it almost feels the combination of summer and the calm before the storm in some ways, because you're absolutely right. We are seeing political volatility over the pond, without a doubt. And I think the one area where we are seeing it is probably in the dollar. The dollar strength probably does reflect a certain amount of anxiousness about French elections. The UK elections are perhaps more predetermined, and that's coming up in July 4th. And importantly, our own set of elections next week, I think, will probably have the market much more focused after that on the outcome to our own election. So yeah, political volatility, politically induced volatility is likely to probably go up. And that's something which we're paying a lot of attention to. So, looking to take advantage of it, mainly.
Well, focus exactly on that. I was going to ask about that. Yeah. We do have this presidential debate coming up next week that people will be focused on. Well, how much do you think the markets will be focused on that? And what does that say about the duration until November? What are we going to be looking at?
So, if I'm looking at duration calls, right now we're neutral. We've been thinking about ranges. We've gone long, we've gone short, slightly long, slightly short. But the range we're looking at is roughly where we are right now. And we think that we could get spikes upwards. Significant rallying from these levels on the back of the data we've had so far, I think would give you good reasons to reestablish some slightly short positions in terms of duration. Overall, though, we're pretty neutral, because if I look at different asset classes, spreads are very tight. Spreads are extremely tight. So you can't just jump in and pick up all high yield, buy all investment grade, buy all loans. However, there are pockets which are interesting, and we are trying to take advantage of volatility when it comes in very selective ways. I think an interesting area to look at actually is structured credit. Now, I'm not talking about jumping wholesale clearly into CMBS, but there are opportunities. And certainly if you look at the mortgage market, we think that there will periodically be opportunities in this market because some of the main risks attached to mortgages actually don't exist. And one of those would be prepayment risks. And we think those are very, very reduced at this point in time.
Just was going to ask you about where do you think that you're getting paid for the risk, if I can put it that way, in the fixed income space, which is your space?
So I'd say that right now you are getting paid to carry. So if I look at all-in returns for even asset classes like bank loans, they are attractive. Right. Typically, I would not say, though, go in and buy a complete index of any kind because those spreads are tight enough that you're not getting much cushion. But, you know, if you look at bank loans, all-in yields are above 9%. If you look at high yield, you're looking at something like 7.5%. That's somewhat interesting, but you have to be extremely careful.